So let's say you bought $1,000 of Apple stock 20 years ago. How much would you have today? It would be around $1.772 million. That would be a 177,164% investment return. But let's face it, you probably don't have the time required to research and choose a stock. That's why today we're talking about ETFs. Not just any ETFs, but the top 5 AI ETFs for 2024. Stay tuned to the end for the best AI ETF and the most important tip to know when investing in ETFs. Welcome back to Fun Financial Insights, and on this channel, we love to break down the complex world of finance in a very simple and entertaining way. Even if you are new to finance, investing, or ETFs, we will break it down so you can take advantage of this opportunity. But first, why should you care about ETFs? ETFs are short for exchange-traded funds. They are a type of investment fund that is traded on a stock exchange, like individual stocks. The major difference between investing in individual stocks and ETFs is that they allow investors to pool their money together to invest in a diversified portfolio of assets, such as stocks, bonds, and commodities. This diversified portfolio is chosen and managed by the fund manager or investment companies that created the ETF. They typically select a basket of stocks that align with the ETF's investment objectives and strategy. Today, our focus is on ETFs that have AI as their objective. Many different types of ETFs are available, each with its unique characteristics and investment objectives. Some common types of ETFs include equity ETFs. These ETFs track a particular stock market index, such as the S&P 500 or the Russell 2000, or include chosen stocks in the stock market. Number 2, bond ETFs. These ETFs invest in bonds and other fixed income securities, providing a steady stream of income and a lower risk profile. Number 3, commodity ETFs. These ETFs track the price of a particular commodity, such as gold or oil. Number 4, currency ETFs. These ETFs track the value of a particular currency relative to the US dollar. And number 5, balanced ETFs. These ETFs invest in a mix of stocks, bonds, and other assets, providing a balanced portfolio with a mix of growth and income. Now, you are probably watching this video on a phone or a computer that can do amazing things. Machines now can think and transform our world in a way we once imagined only in sci-fi movies. This change, powered by artificial intelligence, is moving us to a new era in how we work, think, and invest. It is important you seize this opportunity by investing in the ETFs containing the stocks of the companies powered by this transformation. An AI ETF, or artificial intelligence ETF, is a fund that invests in companies involved in developing or using artificial intelligence technologies. The companies may be involved in machine learning, natural language processing, computer vision, and other AI-related fields. These ETFs are under the class of equity ETFs because they invest in stocks. Now, to understand why these AI ETFs are best and how to do your research if you want to, here are 3 key numbers you need to know their meanings. Number 1, expense ratio. The expense ratio is an annual fee charged by the fund manager to cover the fund's operating expenses. The fee is expressed as a percentage of the fund's assets. Let's look at an example to understand how the expense ratio applies to your investment. Let's say you have invested $10,000 in an AI ETF that has an expense ratio of 0.05%. It means that the fund manager charges $50 per year to cover the operating costs of the fund. Over the course of 1 year, if the ETF grows by 10%, this means that your investment would be worth $11,000 at the end of the year, assuming no other fees or expenses. Now, because of the expense ratio, you would actually end up with $10,950 after 1 year, since $50 was deducted from the investment to cover the fund's operating costs. Now, this may not seem like a lot, but it can have a significant impact over time if you're investing in a large amount of money or if the expense ratio is higher. Next is the year-to-date return, which is the percentage change in the value of the ETF's underlying assets from the beginning of the current calendar year to the present date. And number 3 is holdings, which are the securities or assets the ETF invests in. When you look at the ETF's holdings, you'll see a list of the individual stocks, bonds, or other securities that the ETF owns. The holdings are typically listed in order of their weight in the ETF's portfolio, with the largest holding at the top of the list. And now, as promised, here are the top 5 performing ETFs that have substantial exposure to AI stocks. Number 1, Global X Robotics and Artificial Intelligence ETF, BOTZ. Its expense ratio of 0.68% is quite high, but it's also reasonable for the fund's performance history. BOTZ currently holds 44 stocks. Its top 5 holdings, which account for about 40% of the fund's assets, are Keyence and Fanuc, Japanese companies that make factory automation products such as sensors, scanners, lasers, robots, and electric injection molding machines. Intuitive Surgical, in the robotic surgery medical space. ABB, Swiss maker of industrial automation and robotics products for use in utilities and infrastructure. NVIDIA, semiconductor maker whose chips are used in a wide variety of applications, including autonomous vehicles, virtual computing, and cryptocurrency mining, and are central to many AI technologies. Number 2, Robo Global Robotics and Automation Index ETFs, ROBO. Robo invests in companies that are primarily focused on AI, in addition to cloud computing and other technology companies. Robo holds 80 different stocks with no single holding accounting for more than 2.2% of the ETF's value. Its top 5 holdings comprise only about 9% of the fund's total value. These holdings include players in the semiconductor space, medical devices, automated storage solutions, and a maker of software that helps track fleets of vehicles and other equipment. Its expense ratio is 0.95. Although high, it has essentially matched the return of the S&P 500. Number 3, iShares Robotic and Artificial Intelligence ETF, IRBO. IRBO was formed in 2018 and has less than $1 billion of assets under management. With 118 stock holdings, it's now well diversified. Many of its top holdings also give investors exposure to fast-growing small-cap companies. IRBO's expense ratio is competitive at 0.47%. The fund's performance is likely to be heavily influenced by the overall performance of cloud stocks, since it seems more exposed to cloud stocks and chip makers than AI companies. If you're finding this breakdown and list of AI ETFs a great opportunity and learning experience, and you're hungry for more options for building wealth, hit that subscribe button now. Join other subscribers of Fun Financial Insights, and let's continue this journey to financial mastery together. Don't forget that we promise to share at the end the most important thing to look out for in AI ETFs. Follow till the end and see what it is. Moving on to number 4, Global X Artificial Intelligence and Technology ETF, AIQ. AIQ offers a broad and comprehensive exposure to the entire AI value chain. The ETF charges a 0.68% expense ratio and has attracted just over $690 million in assets. AIQ's performance is up 33.5% over the trailing 1-year period. This is driven by the ETF's large holdings in major U.S. semiconductor manufacturers like NVIDIA Corp., along with large cap tech and communications sector stocks like Microsoft Corp. And the Alphabet Inc. Corp. Currently, the ETF has a high concentration in technology stocks at about 63% of its portfolio. Which brings us to number 5, Wisdom Tree Artificial Intelligence and Innovation Fund, WTAI. If you prioritize low fees above all, you will like WTAI, given that it charges a lower expense ratio of 0.45% compared to AIQ and BOTZ. So far, WTAI has attracted just over $148 million in assets under management. Like the previous AI ETFs, investors can expect a high portion of the U.S. large cap technology sector stocks. The ETF includes sectors outside of technology and focuses on companies with high growth potential. Around 3/4 of the ETF's holdings are held in U.S. stocks, and approximately 80% of holdings are classified as technology sector companies. Now, when choosing an AI ETF, it is important you consider multiple things. If there's one thing you should look for, it will be diversification. One of the primary benefits of ETFs is diversification. This also holds true for AI ETFs. Always ensure the ETF offers broad exposure to various subsegments within the AI sector, such as robotics, machine learning, neural networks, and natural language processing. ETFs are a great way to get started on your financial journey. The AI field is growing, and so are AI companies. You need to start working towards making the best of that opportunity now. Start early, stay consistent, and keep learning. AI ETFs are a lifetime opportunity you shouldn't miss to start building or continuing building your financial empire. If you found this analysis valuable, subscribe for more analysis and research into the world of finance, investing, and wealth creation. Thank you for joining us in this financial adventure at Fun Financial Insights. We'll see you on the next episode.